There you go.
Hello, welcome everyone. My name is Mark Phillips and I'm here with Bert Sullivan, and today we're just going to introduce some things that private equity and venture capitalist investors should be looking at when they're evaluating startups or running due diligence on M&A transactions. Bert and I, over the last number of years, have done a lot of work. I'm in Palo Alto, Bert's in New York, and we've had sort of 25 plus years experience in working with hundreds of companies, looking at growing their organic traffic, spending their paid search, and along the way being engaged by private equity firms and commissioned by VCs, and they're funded startup companies to effectively help grow their traffic. Just wanted to give you a quick, take on a refresher on some of the things that we've seen in these projects. And so I'll dive in, but some of the following case studies, they're all real clients, and this presentation is only a couple of minutes long, and we'll be sending a few others along over the next few weeks. Again, just quickly, Search Forecast, 25-year-old company, hundreds of clients around the world, and here's just some of them. I guess the power is across all industries, all sizes, all geographies. One of the things that we see is, or we look for in sort of that red flag in doing the due diligence, is looking at the pay-per-click dependency. And inside Google Analytics, you can actually run an analysis called MCF, which is multi-channel funnel, and it'll actually tell you, the source of the traffic and the repeat source of that traffic. So in this instance, we can see, this goes back to 6 or 7 years on a project that we were doing. It was about an $80 million e-commerce company. It was being looked to be getting private equity, and we noted that a lot of the traffic increase over the period of December 15, 16 to the previous year. That 83% on the right-hand side growth was actually just coming from paid traffic. And so it's pretty interesting when you under the hood and you break apart what user growth is to see what the source and the referrer of that growth is. You definitely don't want to be buying in or investing into a company that's addicted to Google's, traffic, because as we know, they'll continually increase their quarterly profits, and that's predominantly through the cost of the keyword that their advertisers are buying. And in this situation, we found, so I know it's a little blurry, but 50% of the returning visitors to this site, not just new visitors, but returning visitors, which is a filter you run inside Google Analytics, was actually coming from Google CPC, right? And underneath it, you'll see only 11% was coming from organic. And that's a very, very crucial piece of information and analysis to look for. And then just obviously, what you want to do is buy into a growth story or invest into a growth story. And how do you do that? You look at the channel, their acquisition, and what sources. And obviously, if something's got virality, if something's got word of mouth, if something's in hot demand in a hot space, you'll see organic search traffic increasing exponentially. And in this situation, this particular company, it was only a 2% year-on-year growth. Again, it just it didn't have that explosive organic growth that the private equity guys were looking for. And really surprised sitting in the meeting that a lot of very well educated, financially literate members of their private equity team just weren't aware that this level of information was available. And then what had happened in this situation, it was in this $80 million e-commerce company, they were just getting a lot of traffic directly and a lot of traffic that was referral. That referral traffic was actually affiliate traffic. affiliate marketing traffic. Again, it had a cost to it. And I guess, back then, social media advertising, Facebook advertising was probably in its infancy, pre-Cambridge Analytica scandals and Apple removing all sorts of, inferences around psychographics and mobile detection. So again, we can talk more about sort of social advertising, but across the board, particularly in B2B software companies, it's a hard, it's a higher cost of acquisition than consumer companies. Bert, over to you.
Yeah, what this slide looks at is the correlation between the amount of content that's being published and the traffic that you could expect from that content. So some strategies, some publishers will say, oh, the more content we produce, it'll equate to traffic. And therefore we've got to build out our team and we need to crank out a lot of traffic. And what this analysis shows is whether or not there's a correlation to that cadence. And in some cases, there's a very strong correlation. We produce a piece of content and then it generates traffic. But in some cases, you see a negative correlation. So it's a way to keep an eye on your resources, especially when you're trying to allocate resources smartly, just to make sure that you're not overplaying on just content volume for the sake of volume. Because in some instances, it may not necessarily equate to traffic. It's really more about the intent and finding the right traffic. So content volume may not always be the right thing, but in some cases, there may be a very strong correlation. So what we look at is, the correlation between publishing frequency and organic traffic, just to try to see how well they align. And that's really the insight here. And it's a lens that many investors don't necessarily appreciate or look at. And it's important so you can understand where the resources should go to.
Particularly if you're investing in a subsequent round, and private equity is usually about increasing the investment. So having this,
and trying to make the argument for certain dollars, and you want to make sure that if it's a content driven site that the investment dollars are accordingly, and you really have to look at the traffic in relation to the output.
And just talking about that, when you look across the United States or globally, you very much want to look at not just the user growth by channel, but the user growth by geography, both at a country and a city and a state level. It usually, a lot of at least e-commerce consumer websites will have majority of their sales coming from densely populated areas. And again, it's just another layer of verification and validation by looking at cities. And in this situation, we started to notice that there were high bounce rates. If you run your eye down the red flag column, they are the bounce rates, which is defined by Google Analytics as the number of users that hit a page, don't stay on it. They bounce within 1 or 2 seconds. The moment you start seeing high bounce rates, you need to investigate further. And in this situation, we found that it wasn't just New York and Chicago, it was in multiple cities. And in fact, what ended up happening is that a lot of the referral traffic we mentioned on a previous slide ended up being very low quality traffic and had high bounce rates. The term pump and dump doesn't only apply to the stock market, it applies to, traffic in websites. And as companies look towards funding or look towards growth equity, often that they'll just spend big on paid search or lead gen programs. And you just have to be very aware that it's not just filling the top of the funnel, but you want to make sure that the traffic is actually moving consistently through the website, not just bouncing out. Bert?
Yeah, so share of voice is important. Obviously, when you're looking at a brand, you want to understand how it's sizing up against its competition. And we look very closely at not just the competition as we perceive it, but how competition is in the search results. So what we do here is we analyze the companies on a long list of keywords that are relevant to our category, and then see, okay, who is ranking on those keywords. And that really gives you the share of voice from an organic perspective, organic search perspective. And often what you'll find is the brands that you're competing against are may not necessarily align up to what you perceive, but additionally, you'll start to also notice that there's a lot of other noise in the SERP that you're competing against. You may not realize that. You think you're going up against, say, a handful of competitors, but you really are, from a share of voice perspective, from a traffic perspective, there are other forces at play. So you'll here you quite clearly see Google is taking some of that share of voice. We know that anecdotally, but this sort of really lays it out a little more clearly that Google is competing against many brands. But in terms of focusing on your direct competitors, you can highlight those and figure out your direct competitors where you sit from a market share perspective. So this is an interesting lens that often is overlooked when you're trying to analyze a site vis-a-vis its competition.
Absolutely. And that's it. It was short, it was sharp. We hope it engaged and also, gave you a little bit more perspective. Bert's available. Feel free to reach out. Thanks very much.
Thanks.
Hey, Bert.
Yep.